I might have them. Oh, hey, we are live. We are live. Welcome, everybody. Welcome to this rendition of Carolina Retirement Planners Happy Half Hour. You can see with me, as always, is my daughter, Samantha Shikavich. But Sam, we have a special guest. I will let you introduce our special guest.
We do. We are so excited today to bring you Tom Siomades. He is the Chief Investment Officer of AE Wealth Management, and has decided to grace us with his presence today and talk a little bit about inflation, interest rates, the market, and so we are very excited to have him here with us.
Now we got
Sam,
a bunch
you
of
make
questions.
me sound like the Pope. I'm not the Pope.
Are you sure? I mean, like you might be.
Yeah, I got the plaque. I got the cassock on. All I need is a little white thing right here. Okay.
Yeah, it could be. It could be. I like the look.
And as always, behind the scenes is Amy. Amy is our director of client fun, and also the person that figures out how to put this into Zoom and move it from Zoom to Facebook and all these other things. And
You made some magic happen for us.
hey, let's start with what everybody's drinking. Sam, what are you drinking today?
Oh man, nothing really exciting today. I have to drive to an appointment after this, so I'm drinking a LaCroix, but I do have it in a cool branded Yeti that I picked up this week that I'm really excited about. It's been like very chilly all day.
As you may have seen in the preview, the little video we sent out, Sam and I were this week in Minneapolis, St. Paul for sort of a conference with AE Wealth, and that's where we recorded a little preview with Tom. So we managed to pick up some goodies there from some of the folks, and she's got her. Tom, what are you drinking?
So I'm drinking. We're still working here. It's only 3:30 here in Kansas. So I'm drinking out of this like really ugly Nebraska mug that was in my office when I moved in. So unlike you guys, my goodies that I got at Minneapolis got pilfered by my kids the minute I walked in last night. So it's like, hey Dad, good to see you. What'd you get me? So I just got this junky old plastic mug with Diet Coke. Thanks for asking.
I am drinking herbal tea as usual, because I find out if I drink something too stiff, the half hour can get maybe too interesting. And Amy, finally, what is your beverage today?
Okay, so I'm going crazy today. I'm drinking a PBR, but it's a PBR hard coffee.
Oh, wow.
I'm not mad at it. It's actually pretty okay. Yeah.
Amy's not going to sleep tonight.
No sleep.
But she's gonna feel real good about it.
Yeah.
You'll be wide awake and feeling good.
Then that cancels out. Isn't the one a depressant and the other one's a stimulant? So it's like you got nothing. You're out. You're net zero.
Yes. We'll see how this pans out at the end of this 30 minutes happy half hour. We'll see how I work here.
I'll tell you. And I see that Lynn has joined us, and
I can see in the chat that Bob is drinking a pumpkin ale from Leinenkugel. I love this time of the year, drinking like a spice ale, a pumpkin ale. I love these.
Yeah, we have, and today is also what days, Amy?
Today is National Back to the Future Day. Okay, wait, I got to come on one more time just to show you this. In honor of that, I don't know if you can tell, but I have this like old school Donald Duck pattern on it's a dress, but you can't tell.
Very cool.
So that's what I'm going with today, just to throw back there. So old school
Okay, well, some of the things we'll talk about today may relate to that. In fact, Tom was just mentioning before we got on the air that he remembers as a child and just saw a rerun of a Jimmy Carter clip. Most of you in this call can probably remember the Jimmy Carter years where we had the oil crisis, where we had, you could get odd days or even days for your license plate. There were long lines at the oil. You couldn't get oil. And Jimmy had a suggestion, which at the time was probably a necessary suggestion, but one we don't hope we don't have to relive given our the current oil shortage. What do you remember from that, Tom?
So I remember the whole sweater speech as a kid, and I remember, the gas lines and waiting in the car with my dad to get a fill up and all that. So that was, etched, but not really like a firm memory. So, last night I'm watching TV and they showed that clip and I actually heard what he said. And he said in the daytime, turn your thermostat in the winter down to 65. And at night, turn it, and if you're cold, wear a sweater. And at night, turn it down to 55. And I looked at my wife and I'm like, 55. That's, you might as well not have heat at that point. And you guys are in the Carolinas, right? So, it's not like 55 is cold, like for
55 is
down
real
for
cold
down
for us.
south, right?
Oh,
And I'm saying
yeah.
there's no way I'm like sleeping in 50, even in New England, 55 is cold. So,
Mhm.
that's the part that I had missed that. I had missed the fact that the
Yeah,
actual numbers. And my wife's like, yeah, well, you knew he told us to turn down the storm. So like I heard all that and I remember the sweater, but I just didn't remember the numbers. That seemed like egregious. Like go from 72 to 70 or 70 to 68. I could live with that. At night, if you put it down to 66, put it down to 64. But I mean, 55, that's like gulag numbers right there.
it's
And
cool.
that's
Well,
crazy. I'd be frozen.
if you don't have oil, what do you? Well, actually, I'll tell you. I grew up. My parents came from the coal regions of eastern Pennsylvania, and the houses were heated by coal stoves. Like there'd be a coal stove in the basement, and maybe the kitchen, and you had holes in the floor to bring it up to the bedrooms. On the third floor, when you got out of bed, usually underneath down quilts, it was often like freezing. I mean, or damn close to it. 55 would have felt like a basket of earthly delights. I also rented a room with a family whose son I went to school with in Ithaca when I was at Cornell, and they were English. They came from England, different world. They kept their house at like 60 during the day. And they were just, that was just normal for them, So we're kind of spoiled.
Yeah, but our
But
country's a lot bigger than England. You figure, there's not a whole lot of temperature variation from Scotland, say, to England or Wales, right? But I mean, from Maine to Florida, that's a big difference. So you tell somebody in Maine 55 degrees, or you in Eastern PA, you're like, yeah, I'm okay with that. But you tell that I mean, I remember working in Houston like 20 years ago and people wearing down coats and it was 60 degrees outside.
yeah.
So, and I'm in a t-shirt because I just came down from Connecticut. So go figure.
So what kind of topics do we want to touch on here today? What is it what should we we are talking about the three I's. One of those I's is inflation. I know we had some questions on inflation, some folks ahead of time bringing it up. You have any thoughts on where inflation is going and the like?
Sure. So what's interesting is that when we started seeing inflation kind of pop up early in the summer, late spring, we had all this talk of it being, well, it's just a glitch because, people are getting back to work and, the economy is sputtering back to life. And that the word for that was transitory, right? This is going to be a transitory period. And at that point, I'm thinking to myself, do we really care how quickly we get to prices being 20% more than where they are today? I don't think anybody cares that we got there all at once or 5% at a time for 4 straight months, but somehow we managed to get there. But that doesn't seem to be abating, right? So prices have risen. There's a bunch of stuff, you see it every day, of stuff stacked at the ports. There's not enough people to move it. California, with some of its environmental policies, trucks, they discourage trucking in the state. This is the same state that banned lawnmower engines, right? So how are you going to get a truck from the port that comes in California to somewhere else? So I don't really see these things as being transitory. I think the problem that where we're at is that there was a lot of money pumped into the economy. You didn't have a lot of people working. So the challenge there is you didn't have less people consuming. The same amount of people were consuming the same amount of stuff. But now there were a lot of people that weren't working. So the same amount of stuff wasn't being made. That's on our end. And then on the other side, you've got container ships and logistical hangups because people don't know whether to send something or keep it. And so now all this stuff is stacked up and it's not getting where it needs to. And so the whole supply chain, in my view, is going to take a long time to clear up. So I don't think inflation is going to stop, and not until we get, an equilibrium between the amount of money that's available to buy stuff and the amount of stuff there is to buy. And I think right now there's a gap, whether it's housing or whether it's, stuff at the stores or chips for trucks, you name it. I mean, you look around and you see all of these shortages, and it's going to take a while for stuff to get back to normal. And it's not something that's going to be over in 3 to 4 months. So that's kind of my view of it right now. I think it's going to be with us longer term. It's just a question of, when is the cash that's out there get bought up by the stuff that's available, and then you'll have another wave, right? Then you'll have people complaining about deflation because people will get greedy, right? Selling their stuff at these really high prices, and so they're going to make a ton of it, and then they're going to dump it on us, and they're going to be like, well, now, hey, you were used to paying 120% for a TV. Well, I'm going to make a bunch of them, and then all of a sudden they can't sell them, and you'll be selling the TVs for 50% on whatever it took to make them. So that's the concern, is this whipsaw. So that's what I'm seeing. I don't know if people have a different experience. I'm happy to talk about it, but at the end of the day, it was really caused by the fact that you didn't have enough people making stuff to balance out the money that was out there to buy stuff.
Yeah, and we also see even in housing, the whole COVID thing, I think, has encouraged a lot of people to move, to go work remotely or retire early, and we're seeing demand for houses, at least around
for bigger
here.
homes.
Yeah,
Bigger
crazy.
homes. They want a home with a pool and a yard so they can enjoy the outside.
Well, how
Right.
about
So that's another classic example, right? There were a lot of programs in place during the coronavirus that were around to protect people from getting evicted and from getting people, they don't have an income, so let's give them a rent or mortgage moratorium. Well, if you have people colliding, right, with the desire to get out of a city because it's a sicker place, or there's people in closer proximity or whatever, and so they want to get out, like Sam said, find a bigger home. Well, if no one's moving, what are you going to move to, right? And then you had that run on builders and contractors who are like saying, what? Well, I'll build a house. Well, we don't have any lumber. We don't have any workers to build it. And we're all backed up. And you can't get appliances for 6 months because they're on a ship somewhere. So
you can't get shingles.
Yeah. So, that's the crazy part about it. And so what that's done is that's pushed real estate prices to the point where, I don't know about you're saying where you guys live, prices are really high, but like even in my neighborhood, I mean, a house doesn't last more than about 3 or 4 days. And, and people are not willing to sell. That's the other thing. So.
Well, let's take a second and say hi to some of the. Let's take a second and say hi to some of the folks that have joined us. Dan and Barb in the mountains there are enjoying some gin and tonics.
That's one of my favorite drinks.
Phil is here. Alexander is here. Robert says, don't remind him of the Carter years. We are trying to all remember the whip inflation now buttons, and Nancy says she remembers the longer line. She was getting her driver's license at the time. Rick and Marcy are here. Amanda says that when 55 means I'll have to wear real shoes.
Down here at the beach, we live in sandals.
Lynn says, growing up, we put the heat down to 58 at night, and let's see, we have and Debbie's here, and Debbie and Jean are here. Matt and and Dave is here as well, and his so.
Also, Amy wanted me to remind y'all that we're trying to make the Facebook algorithm like us even more. Y'all are doing an excellent job with everything that you're doing. But if we're saying something that you love or hate or think is funny, if you go and like give us a laugh or a cry or a frown, Facebook likes emojis. If you give us some emojis during this, you just boost us even more. So we would really appreciate that.
Thanks,
So
Sam.
emoji.
Thank you.
Thanks, Amy.
Well, what about interest rates? Tom, we've seen interest at, bouncing right here on the bottom for so long. I mean, I think like treasury, tips don't even pay anything, right? Which what's the thoughts on interest rates in the future?
So, the interesting thing about interest rates by and large is, there's a lot of people that's been probably 10 years, 12 years since we've actually seen what seems like normal rates, because probably since the late 70s or early 80s, you've seen the steady decline in long-term rates, right? And I remember even back in 07, 08, when I was managing money and I'd have clients come in and people would literally be, on the verge of tears because they had a 30-year treasury that was paying 15, 16%, right, every year. And they had to reinvest in a 4% or 5%. And it's like, that's a huge decline in your income, right? So, but part of the lower rates has also created an environment where if people want real opportunity and growth, they have to go to the stock market. That, the old adage, Tina, right? There's no alternative. The challenge now is the Fed has a dual mission, right? And its mission is to keep rates, at a point to prevent inflation. Well, we just talked about that, right? If you have too much money in the system, which low rates encourage, you get higher inflation. And people on fixed income, retirements, well, some things it's good for, like if you have a fixed income mortgage, obviously if with inflation, that feels less painful if you're getting a paycheck and your salary rises, right? But if it's a lot of people that are counting on Social Security or retirement checks that are fixed income, that's not a good thing, right? So, the Fed is mandated by one of its core missions is to make sure that inflation doesn't get out of hand. So they have this 2% target. Well, if we're running at 5, guess what? Chances are really good that they're probably going to, have to do something about it. Their secondary mission is to get fuller employment. Well, employment's coming down. I mean, it's not where it was during the height of the pandemic, but it's coming down to probably it's below 5% now. And how much longer now, if you've got everybody working and inflation is up, it's time to start jacking up interest rates. Now, what's interesting is they've been engaged in something called quantitative easing, which is basically they buy government securities and take them off the market, and then they put cash back in, which leads to more cash available to either borrow and spend, right? So they're looking at stopping that. They're thinking about starting to taper that. So they buy about 120 billion a month. So they're going to cut that back and hopefully stop it by next June. But that's just the stuff they're buying. They're going to leave rates alone until that point. And then at that point, they're going to have to start addressing actually raising physical rates. So it's going to be frustrating for people if they go to the bank and, I pretty much start like breaking out and, getting the shakes when I'm parked in front of a bank and you see one of those 8-foot posters that says, hey, give us $100,000 and we'll give you 0.5%. I'm like, it's like, why would I ever do that? But, that's going to be the last shoe to drop. So when you start seeing CD rates going up, that, is a direct indicator of what the Fed is doing. But we've been expecting rates to rise for the last 10 years. There's been a bunch of reasons for it. And the only caveat I would add to that, the only concern I really have is our government has a lot of debt, regardless of who is running things. And if we raise rates and we actually have to start paying competitive interest rates on our debt, that's going to be really hard because the government likes cheap debt, right? Because they can spend the money on other things and the more they can borrow. But what they're doing is they keep rolling it over. So, They borrow
Yeah.
something at 2%, and they roll it over at 2%. Well, what happens when you got to roll it over at 6%? Now, all of a sudden, you
Yeah.
got triple the debt payment.
Yeah.
And where's that going to come from?
Right. I always liken to people, I think everybody with a tax return has a $228,000 mortgage they don't know about. That is each
Yeah.
tax return's portion of the $29 trillion debt. Well, if it's at 1%, you got, if they're paying 1% on the debt, you're paying what, 2,800 or something, if you're paying 5% on that debt, it's getting out of hand. So it's going to be interesting. It's one of the things that worries me the most, where if we keep going like this, what's going to happen? Japan has managed to keep their interest rates low, and they're in way more debt than we are for 30 years. But
Well, yeah, but they also have declining population, and their economy hasn't done anything. The stock market's been pretty dead. So, it definitely, look at, I think of money as sort of like, it's kind of like water, right? It's going to find the lowest spot that it can, right? And it's going to find a way. It's not something that's just going to continue to just find a new level, right? It's just going to go to the place where the path of least resistance. And I think that's the unfortunate thing about Japan, though, is that, they were held up for so long as a model, right? Back in the 80s, the Japanese way. Remember all the factories,
Yeah.
everybody had to do it the Japanese way. And then, like, where are they now? And the fear is that we're going to end up in a similar boat, because we're just going to take more and more money to try to just, prop this thing up. And there's no real good answer. I mean, what's the other answer? That we start cutting benefits for people? I mean, I'm kind of like, when I see all the money that they're talking about in Washington spending, I'm like, let's fix Social Security. Everybody will benefit from that. Let's fix Medicare. Everybody could use that, because those things are going to be bankrupt in say, 10 years. And what are they going to do? Borrow more for that? Who's going to lend us the money? So if you're going to fix something that that all of us can use, and I don't think anybody would complain about that. But as it is, we can't even afford any of that either at this point. So it's a challenge. No.
It's a challenge.
Yeah.
Debbie has an interesting point. When her first home loan was 10.75%, but at the time she was getting 21% at her savings and loan, so.
Now, Tom, we're, for the last especially year and a half, we've just been bombarded by horrible news, just blow after blow. And we've just continued to see market highs, with the exception of March 2020, we've just continued to go up and up. Are you concerned? Where do you think we're going to go from here?
Yeah. So here's, like, actually yesterday we hit a new record, right? After all the negativity, you're hearing about all of the loss in consumer confidence, the whole Afghanistan, all of that stuff that's been floating around in the news. And not to mention, you got people coming on saying, there's shortages, there's this, that, and the other. So the reason, in my view, the reason for that is, frankly, is there's all that money that's sitting on the sideline that has no other alternative than to go into stocks. And that's why it keeps flowing then. And you've got, the crypto craze and all the meme stocks, and you've got all of these sort of, well, today, I think it was Donald Trump's going to do his own Twitter thing. The thing is up like 300%, the company that he's going to merge with. So, a lot of that stuff is not rational stuff. But the challenge here is that what's been sort of pushing things the past few days anyway has been better earnings. But think about, like, you got to read the fine print. When they're saying sales are up, right? That doesn't mean more people bought stuff. That just means they got money in, right? So if you bought a pair of socks for $5 and then you bought the same pair of socks for $10, I would argue sales are up, right? Yeah. But it's the same, but it's not any more sales. It's just sales are up, right? Revenues are up. And I think that's what happened with people sort of shook off the pandemic stock market because they didn't get scared as far as stocks were concerned. They're like, well, there's no other place to put it. Great. This is a great opportunity to pile back in. And they were rewarded, right? They were rewarded because we literally got back to levels that we were at before the pandemic by August. And then there was a little fluffing around the inflation. The election. And people got a little nervous in October, but then the election was over and then people moved on. And then they saw that the government was going to pump all this money into the system. So like, hell, where else are we going to put it? We're not going to put it in that 0.5% CD, right? So they just kept on. And that's kind of what's going on. But eventually, you know, earnings really are the long-term driver. And I think when people start paying a lot of money for stuff, they're going to be like, you know, I'm out. I can't spend this much on this type of stuff. And eventually what it's going to do is it's going to manifest itself in earnings and it's going to roll over. So in my mind, I think we're okay through the end of the year. I think it's going to be a crazy Christmas holiday season as to, you know, with all of these shortages. We'll have to see how many people get fed up and upset or how frustrated they may get, or it may not be a thing. I mean, I don't know about folks on the call today, but like, I don't have a problem finding anything on Amazon. Why is that? It seems like everything is there the next day, but then when I go to my local store to find stuff, I can't find anything. I mean,
Yes.
my kid in college just bought a TV, and I'm like thinking, I'm not complaining that all these TVs are made in China and Korea, and yet she had hers in 2 days. I don't know. I mean, it's weird. So that I think is going to be a big test, right? If we have a abnormal holiday shopping season,
Mhm.
that's not a good thing for the beginning of the year.
Yeah, a lot of stores depend on that, and if their supply chain breaks down and they can't get stuff to sell, and then you have the Amazons who just seem to be one step ahead of the supply chain. I actually heard a lot of stores were chartering their own ships, smaller ships, but they were sending their own ships to China to bring the goods back. And then they could go into the smaller ports that weren't oversized. But we are bumping up against the top of the hour. You know, Tom is again the chief investment officer at AE Wealth. In fact, many of you clients on the here are AE Wealth is the registered investment advisor that helps us find the opportunities and find the strategies to help you invest your money. So it's great to be able to share this, talk with him this half hour. We are now coming to before we come to the drawing, Amy, what's on the agenda for next week?
Ooh, it's a good one. You see what I did there? Do you like that?
I like that. That was very good.
Yeah, you like that? It is a trick or treat special. Oh,
That's right. We are going to talk about different things, you know, different financial products and strategies, you know, home equity lines, reverse mortgages, cryptocurrencies. We're going to say, are they trick or treat? Are they a good thing, are they a good or bad, or what are the good or bad aspects of both? So we're going to kind of have some fun for Halloween. And if you have anything that you're wondering, is it a trick or a treat? You know, as usual, email it to us and let us know. As usual, if you would like to, you know, chat with us, especially clients can always know where to call us in the office and get in touch. If you're a visitor here, you can go to Carolina15, Carolina, the number 15 and .com and book a 15-minute phone call with us just to chat about whatever you want. And so we'll see you next week for trick or treat. But now's the best part.
All right. So for those of you who are not familiar with this, every week we give away 2 bottles of wine delivered directly to your door from a local bottle shop, Fermental. Actually, I just read that Fermental is moving. They're going to be moving downtown to the Cargo District. So for many of you who live over in Leland, this may be actually closer to you to go visit them. So this is kind of pending. We'll let you know whenever they've made the move. But to enter, I know Amy's sad because they literally are right across the street from her house right now, but they're going to
seriously boo-hooing over here.
I know she's real sad. But to enter each week, all you have to do is reply that you're, say that you're attending our Facebook event. If you share the Facebook event with friends and they say that they're going, you'll get extra entries. We send out like little bombs and tidbits throughout the week to let you know what our topic is. And if you reply to that, we will enter you in as well. And if you let us know that you've sent that email to a friend, we'll give you additional entries. So there's a lot of ways that you can get your name in my bucket multiple times. So our winner of this week of 2 bottles of wine delivered directly to your door from Fermental Bottle Shop is, and he had a question today too. I know that he's here watching. Bob T. So
Well, good.
Congratulations, Bob. You are our wine winner this week.
I like
And
it.
Amy will be calling you to find out what kind of wine you like. So
Yes, they're not necessarily my crazy questions, but all the crazy questions.
Mhm.
but
And
with that, everyone, thank you for coming. What number is
you.
this, Amy? Do you know what number we're?
Of course I do. This is number 38. Next week is number, or not 38. I'm sorry. This is number 68. Next week is number 69. Crazy.
68 weeks we have been doing this, and we appreciate you all coming. It's been fun. Next week is trick or treat. Be sure to tell your friends, and if you refer us, be sure to email it in so we put an extra thing in the jar, and send us things you'd like to hear. I think I've got some ideas coming up. The crazy 5-year Roth withdrawal rules. There's like 5 of them. It's bizarre, and we'll have some fun with that one, and a whole bunch of other things. So
yeah, I do want to add one little thing, and I don't want to interrupt you, but I know that people like to add like questions and things. And next week, I know that with the trick or treat, that bag is going to get full super quick, and we only have 30 minutes. So definitely if you have any trick or treat financial products that you want it covered, get those in quickly because it's going to fill up. Yeah, definitely get those in.
sounds good. Well, with that, everyone,
And
it's been great. You have a great weekend.
Thank you, Tom, for joining us
Thank
today.
you.
Thanks, everybody.
appreciate it.
Everybody
Yes,
have a
thank you.
People have
great
thanked
happy
you here
Halloween.
on the chat as well, and we appreciate you all. And we will see you 4:30 next Thursday for the next happy half hour.
Ooh.
Take care, everybody.
Bye, guys. Take care. Thank you.